Welcome to BusinessLine's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, I'm Aarati Krishnan, consulting editor with businessLine. And today we are happy to have with us Ms. Monika Halan, one of India's most respected voices in personal finance and a sought-after writer and speaker on the subject. She is the founder of Dhanchakra Financial Education and has made significant contributions to policy making on financial savings and products in India. She is currently chairperson of SEBI's Advisory Committee on the Investor Protection and Education Fund. She is the author of a best-selling book, Let's Talk Money, and has recently published its sequel, Let's Talk Mutual Funds. So the subject of today's conversation will be on mutual funds. So let's start off right away. Monika, since you've recently written this book on MFs and I've been reading it, so a young person just starting out on a financial journey, she has many simpler choices. I mean, she has a bank account, she can open an FD or an RD. There can be a FD with some NBFC, there can be gold. So why should she choose a mutual fund over other options?
Thank you, Aarti. Thank you very much for inviting me on the podcast. And I have to say, I've been a big fan of your work. So I'm doubly delighted to be here on this with you. So the question, why mutual funds? In fact, I take that question up in the book very early on to say, why is it that this is a product category for a retail investor? Now, the way that I will think of the universe of options before me is to divide it according to asset classes, which means the investor should be thinking between debt, equity, and real assets, rather than thinking of products of endowment, ULIP, FD. So it's more a training of the mind to see that I need to first figure out my asset allocation, which is debt. And the first thing that you do is your debt and equity allocation. When you start looking at the world of finance through this lens, then you realize that it is far easier to construct a portfolio with mutual fund products rather than try and do this with disparate products out there. And I'll tell you what I mean by that. When you think of choosing between two products, we start looking at their attributes. We forget that they have a place in the portfolio which should satisfy the portfolio requirement of a debt and equity allocation. The mutual fund, it's not a goal by itself, it's a route to equity, debt, and real assets, and mix of all of these. So I would look at this as a pipe that connects your money to the desired asset classes and the divisions within that asset class for your portfolio. For example, if you are deciding that you want, say, 60% equity, now, 60% equity is not one product. You will have to diversify within equity, within large, small, mid cap. Maybe you might want a foreign allocation for a portfolio size that is large enough. Again, I find that the way that the industry has been structured, it is far easier to build a sophisticated portfolio using just mutual fund products across debt, equity, and gold. So that is one, just in terms of fulfilling the needs of a portfolio. The other reason, of course, is for a financial product, we have a regulator who's been very proactive in taking the risk of fraud out of the product. The disclosures are world standard in India on mutual funds. The costing is, they have collected all the cost and they've put it in one number, which is called expense ratio. SEBI has removed the upfront loads, which encourage hard sales and churning. They have removed that front load of 2.25% long back. Well, there has been a whole lot of action under the bonnet, where expense ratios have been brought down over years, where inter-scheme transfers have been curbed, where a lot of the sharp practices that fund managers get into under the bonnet have been addressed extremely well. So investors sometimes don't understand how much work that a regulator has actually done over decades to make the product retail friendly, which is why I'm saying that for a sophisticated thinking about your money and its future, it helps understand this product because it ticks so many boxes.
Yeah, that description of yours that mutual fund should not be viewed as an alternative to some asset classes, but as just a pipe that connects you to different asset classes. That is the key.
People will say that, should I buy a mutual fund or should I buy a stock? I mean, apples and oranges. I don't know how to answer that question because mutual funds also have debt, also have gold. It's a question which displays a lack of financial literacy about the possible choices out there.
This thing that most investors remember when you talk mutual funds for the first time is that disclaimer, which is rapidly read out on TV, etc. Mutual funds are subject to market risks. So in your book, you talk about the kind of risks that mutual funds do not subject you to. That is important, right? So when you say market risks, people seem to think, oh God, that is the only risk I will face, and other assets or other products don't face that risk, but mutual funds will subject me to it. But there are many other kinds of risks, right? And can you name some of them?
Yeah, Aarti, it's a great question because we tend to only look at the volatility, the risk of volatility, which is the risk of price of something going up and down rapidly versus a whole lot of other risk. My biggest risk is the risk of fraud, the risk of someone running away with my money. The entire crypto story was a story of fraud, of miscommunication, deliberate lying about the product and what it could do. Money was collected and it was siphoned off and people ran away with it. In its 30 years of history now, we haven't had a single instance of a mutual fund running away with anybody's money. There has never been a vanishing mutual fund. We remember vanishing companies, we know people, the multi-marketing schemes, but we've never had a vanishing mutual fund. Funds get sold, they get merged. So for an investor, I would say this is my biggest cloak of safety, that here is a product where no one's going to run away with my money. That's the first one. Second is that the disclosures in this product category are so high. Again, the regulator has worked so hard to ensure that proper disclosures which can be understood, are made. For example, a whole lot of focus goes on to benchmarking. What is a benchmark? It's the average return that product category gives. So there was a time that the industry could fix whatever they wanted, but then SEBI has put in rules as to what benchmark you can use. Economic theory says that free markets will solve. We find on the ground that free markets don't solve. Which is why, unfortunately, the regulator has gets into very micro regulation. So in terms of risk, then there's also the risk of illiquidity. So real estate as an asset is an illiquid product because it takes you a long time to get into it and it takes you a long time to get out of it, and there are large transaction costs. Mutual funds, on the other hand, again, due to regulatory action, you get in debt funds, you almost get your money the next working day. An equity fund can take 3 working days, which is not bad at all, right? At no loss of value. For example, if you have a 5-year fixed deposit and you want to withdraw in 1 year, there is a cost to that withdrawal.
Absolutely.
So you have this risk of illiquidity in many products. And then, of course, the risk of obfuscation, the way that we see in the life insurance industry. You are buying something which is not described to you properly. You don't understand the costs. You don't understand the costs of not continuing with the product. I'm saying mutual funds have some categories have something called an exit load. It's not a back-breaking cost. For example, in an endowment plan, if you don't fund your second premium, you lose your first premium. You don't get anything. The regulator allows that, you see? So it's a regulatory issue where even after 5 years of funding an endowment plan, if you don't pay this, you lose half your capital. So we're not even talking of a loss of capital. We are saying there will be a small charge on exit on the NAV within a certain period. Typically for debt funds, it's 0. And for equity funds, it's put at 365 days so that people are encouraged to at least get the long-term capital gains tax benefit. These are the sort of risks which people need to think about rather than just focusing on this volatility of the market. Over the long term, this up and down jagged volatility becomes a nicely smooth upward curve.
Absolutely. Absolutely. If you look at the Sensex graph from, say, the 90s, it is just an upward moving line. You can hardly see the intermittent blips that it has suffered. And your point about real estate is absolutely spot on, that if you want to exit, the amount of work it takes, the number of months, and you don't even know the price at which you will be able to exit that piece of land or property that you own, because that is so subject to the counterparty, what they accept
Correct.
and things like that.
Correct. So
Yeah.
all of this goes into the fact that it's a product retail ready for somebody who's dealing in tax paid money, essentially.
Yeah. So, talking about these regulations, I do agree that SEBI has been a very proactive regulator who's focused a lot on investor protection. But in recent times, we have seen some incidents crop up, like Franklin Templeton suddenly announcing the winding up of six debt schemes because some of the securities were illiquid. We've seen this case of the Axis mutual fund dealer front running his funds trade. So, is the industry really regulated in a watertight manner? And what do you think about these incidents?
Aarti, there can never be a zero accident set of regulations. So even on the roads, you have elaborate systems of traffic control, policemen,
Yeah.
but yet you'll have accidents. So nobody can ensure a market where there is no sharpshooter who's running wild.
Okay.
And the other part is that I feel that whenever such gaps are brought to the surface, SEBI deals with it very quickly. For example, let's take the Templeton case.
Yeah.
That brought into focus the fact that the risk in debt funds was not being mapped very clearly. So even on the risk, there's something called a riskometer.
Correct.
Even on the riskometer, the very high risk funds of the six funds were being labeled low and moderate risk.
Right.
So SEBI realized at that point that debt funds have it's a risk of it's an interest rate risk, it's a liquidity risk, and it's a credit risk. So Templeton's problem was largely a liquidity problem. It was not a credit problem. It was a liquidity problem. So that entire episode resulted in a very deep dive into making that riskometer dynamic. And honestly, I have not seen a riskometer like this anywhere else in the world, which dynamically every month the fund house has to indicate a composite risk score is made up of liquidity, interest rate, and credit, and update the Amphi site with its risk noting. Not only that, at the end of the financial year, it has to map how many times did this risk score change. So, for example, in a liquid fund, if you see the risk is bouncing up and down many times, you know that this is an unstable fund. And for a liquid fund, I need stability. So, part of education, I think, has to happen to investors to say that there was a problem in the market. The regulators found a way of doing better disclosures. Other than tightening the funds and all of that, what happens bilaterally, we don't know. But in terms of just being able to indicate the risk, especially in the debt fund part of the market, far more clearly, I think, has been very well done. So, yes, there will always be problems in the market. How is it that the regulator is going to respond? Bury its head in the neck, like some other regulators do, or take it by the horns and say, okay, how do we do this so that this accident does not happen again? A regulator can be in denial. I don't see that happening with SEBI. I see them accepting that this has happened. What is it that we can do that this accident is not repeated? So I think in that way, it's a very healthy practice of getting the markets right. All I can say is accidents will happen. Investors need to always look for fund houses and products where this risk is mapped out a little better, that they understand that this fund house which doesn't get up to some of these things, and then entrust their money. So finally, when you're choosing funds, you're usually left with a set of 3 to 4 schemes. And then it is a subjective picking off a fund house. My suggestion is you be very careful at that moment, because finally in the last 4 or 5 which are left, there's very little to choose between them.
Right.
I would look at the pedigree of the fund house to say, what have they done in the past? Am I able to trust them? What are the risk management practices in place? Which translates into headlines saying that this fund did this fund did that. So accidents will happen. This is the market, accidents will happen.
So you've been part of regulation making for mutual funds for a very long time as a part of the Mutual Fund Advisory Committee of SEBI. I think you were there between 2009 and 2021, a really long
Correct.
stint. So one of the most important reforms that happened then was this MF categorization, which
Yeah.
aimed to simplify choice for investors and basically make funds more true to label. And that finds quite a elaborate mention in your book also. So what
Yeah.
I'd like to ask is, even after the categorization, there are 37 categories of schemes that every AMC can launch. So that's still a fairly large menu for a simple first time investor to choose from. So if I'm just a new investor looking to choose mutual funds, can I make do with just 2 or 3 categories, and what should they be?
It's a great question, and I have to tell you a little bit of the story. So this
Uh,
has come out of the MFAC, the advisory committee process. Actually, it was one of my solutions because there were a
okay.
lot of Me Too schemes, and I remember writing a column which suggested this, and SEBI was alert
Hmm.
enough to pick up the idea and actually implement it because I had said one fund per bucket, basically allow every fund house to have one scheme per bucket,
Hmm.
and you define the bucket so that they're true to label.
Hmm.
The thing that you will also realize being part of the MFAC is that there is also an industry out there and they have interests
Hmm.
as well. They have been running thousands of crores of AUM. The market is not only there for the new investor, it's also there for the sophisticated investor.
Hmm. Hmm.
So the argument is why take choice away?
Hmm.
Why is it that you will not allow, say, a credit risk debt fund, which is the credit risk can get very high? For maybe a more safety seeking debt fund investor, this is not a right product category. But at a
Hmm.
certain level of wealth, I might
You
want to
do want
diversify.
it.
So
Hmm.
that's the answer, that the market and the regulator is not just catering to a new investor, it is catering to every possible investor out there. Therefore, you
True.
see the plethora of
This many
choices.
categories. Hmm.
So,
Hmm.
11 equity, 16 debt, 6 hybrid.
Hmm.
Again, that is in fact the question I have addressed in the book because it comes down to choice. My suggestion is you first choose your allocation, then you choose the categories, and then you do
Right.
the hard work of choosing the schemes within the category. This process is not an easy process. We
Right.
are not in the business of recommending 5 funds to invest in. That's so insulting to the listener, to the viewer, to say, here are 5 funds. Now, like, there is no generic diet. It is
Definitely.
bespoke to the health issues of each person. Similarly, there isn't a portfolio which is a bespoke portfolio. Other than saying that, look, an index fund on the Sensex or the Nifty 50
Hmm.
is your broad market long-term average return. So the person who doesn't really want to do any work, doesn't want to do, then you just have to choose an index fund and just sit with it, keep funding
Right.
it for the rest of your life. That's for a fill it, shut it, forget it investor. So we can
Right.
say, okay, that's what you can do. But in
Hmm.
every other category where you're trying to build a
Hmm.
portfolio with funds, active funds, mix of active passive, that hard work will have to be done of choosing your categories and
Right.
then the schemes.
Yeah, I do appreciate what you're saying because today we have any number of influencer videos which tell you 5 stocks that can shoot out the lights and 3 funds which can make you a billionaire, etc. And finance is really not that simple, really. It has to be very personalized and customized.
No, and there is no, who knows what the market will do tomorrow? I can never
Yeah.
predict. We know the signals of a recession, we know the signals
Uh,
of growth at 7%. Those seem
right.
to signal that the markets will do well. But you can have a global calamity soon and then the markets will tank. So it's very, very scary
True.
to predict markets even with a 3 or a 5 year horizon. I would say
Mm.
that 7 to 10 years is where I begin to say yes. I think
Uh,
you can say that you will get GDP plus inflation plus
mm.
equity return. Okay, if there's a formula, then that is the formula. Long term, this is what you could possibly, on an average, should be getting.
So recently, one major change that has happened is that the tax indexation benefits given to debt funds have been taken away. And traditionally, debt funds have been favored by institutions and corporate treasuries along with retail investors. So with this tax part going away, is there still a case for retail investors to invest in debt funds? And are there situations where they should go for the simple FD or something over debt funds?
Right. So you choose a fixed deposit when you don't understand debt funds.
Hmm.
So people who don't understand mutual funds should actually come to debt after they've understood equity, because debt funds risk can be, you think it's a zero risk product, it is not. So it's far
Yeah.
more harmful for you to recover from losses in the short term than in the long
Right.
term. So the case for debt funds, I believe, still remains. Because again, like I said, investing is not just about the risk of volatility, it is also not about the highest return. And it's a controversial statement to make, because people seem to think that targeting the highest return is the goal of investing. It is not. It is also liquidity. It is also the certainty that the money is going to be there when I need it. It is also the ease of entry and exit. So I think the case for debt funds still remains, whatever the tax impact. Once you have built the pipelines between your bank and the platform that you invest through, it literally takes 30 seconds for you to make a transaction once you get proficient at it. Yeah, so you can do the FD, but unbinding an FD makes you lose a lot of interest. So even the two-in-one FDs, they portray it to be this great product, but it isn't. One additional thing is that the industry actually has innovated very smartly, and they have built products like a SIP, SWP, a systematic investment plan, systematic withdrawal plan. Now, what is an SIP? You park money in the debt fund of a mutual fund, and from that debt, it goes to equity at regular intervals for a predetermined amount.
Right.
And an SWP is the reverse of that, that possibly from an equity fund, you're funding, you could be funding a debt fund for use maybe 3 months later. It can, of course, come and sit in your bank account, but you could also start collecting it in a debt fund. So the pipelines are built between equity and debt funds of the same fund house. So especially when you want to use such products where you're parking money in a lump sum in a debt fund, and there is a systematic transfer plan, for example, which is happening, then the debt funds utility becomes even more obvious.
Yeah.
So I think once investors figure the different options out, using debt funds becomes far easier as compared to parking money in a fixed deposit. Not for a moment am I saying that FDs are bad. I say again and again, if you don't understand debt funds, there is absolutely no shame in being in a fixed deposit. Don't let anyone shame you. These are great tested products. Stay with a large commercial bank. Don't go for the cooperative banks. I mean, all banks are safe, but these too big to fail banks are really very, very safe. So I think the case for debt funds remains despite the tax benefit being taken away, Aarti.
So I just want to ask you about your own portfolio. So I'm sure a good bit of it is in mutual funds. So broadly, how do you approach selecting the funds and the allocation? And also, how do you accommodate alternative assets like real estate or say high yield debt into your portfolio? I mean, outside of the mutual funds.
Aarti, I invest in exactly the way that I write in the book, both Let's Talk Money and Let's Talk Mutual Funds.
Okay.
I actually experiment on myself before I write the books. And it's exactly what I say, that the one piece of real estate is the house that we live in. I have zero real estate beyond that. I don't like it as an asset at all because of one, the cash component, the transaction time cost. Real estate as investment has very low yield. It's about 1.5% to 2% on residential.
Right.
Plus, there is the people don't understand their costs of maintaining the real estate asset. And there's this whole headache of maintaining a tenant's demands of this is not that, so money is not just about the highest return. I go on saying it is also about peace of mind. I don't like having real estate. So I have the one house fully owned where we live. Plus, the entire assets are in mutual funds. There is no other asset. There might be some old fixed deposit still lying, literally just for an emergency, you put that aside. For this doomsday when everything fails, you have, like COVID happened and everything freezes. So you might want to, this is like really your doomsday purpose. But other than that, everything, 99.9% is in mutual funds. I have my own allocations, which I don't want to share because my risk appetite is far higher because I know the products. So therefore, I dislike telling my allocation. I'm able to understand risk of these products. Therefore, I'm able to build a fairly high risk portfolio. That might not be the answer for most of your listeners.
So thank you so much, Monika, for being with us on this podcast. And you shared a lot of interesting insights about how a person can go about choosing mutual funds. Thank you, listeners, for tuning into BL's SOE podcast.